If you're thinking about buying real estate in 2026, you need to hear this. I'm about to expose 5 states where purchasing property could be the worst financial decision of your life. This isn't about politics or personal preferences. This is about cold, hard data that reveals which markets are heading for disaster. Before we dive in, let me be crystal clear about something. Real estate isn't just about finding a pretty house with good schools nearby. When you buy property, you're investing in an entire economic ecosystem. You're betting on tax structures, migration patterns, business climates, and regulatory environments. Get it wrong, and you could watch your investment evaporate. I've been analyzing real estate markets for decades, and what I'm seeing right now is deeply concerning. We're witnessing a massive economic shift across America. Some states are becoming powerhouses, while others are turning into financial graveyards. The gap between winners and losers is widening every single day. The states I'm about to reveal share dangerous characteristics. They have negative migration patterns, hostile business environments, crushing tax burdens, and deteriorating fundamentals. These aren't temporary hiccups. These are structural problems that will plague these markets for years to come. Let's start with the first disaster zone on my list. California tops my avoid list, and here's why. The Golden State has become a financial nightmare for middle-class homebuyers, with state income taxes reaching nearly 14% at the top bracket. Combined with soaring property taxes and astronomical home prices, California is pricing out its own residents. The migration data tells a devastating story. For years now, California has experienced negative domestic migration. More Americans are leaving than arriving, and it's not random people fleeing. The middle class is evacuating. These are the taxpayers, the business owners, the productive members of society who are heading to Texas, Florida, Tennessee, and Nevada. Why are they leaving? Because they're tired of paying $2 million for a house that would cost $400,000 anywhere else. They're exhausted by regulations that strangle businesses and tax policies that punish success. But here's the real kicker. California is sitting on hundreds of billions in unfunded pension liabilities. How do you think they'll pay for those obligations? Higher taxes. And what happens when taxes go up? More people leave. It's a death spiral that will devastate property values. The only thing keeping California real estate prices inflated right now is artificially low inventory. But as more residents flee and more homes hit the market, supply will overwhelm demand. When that happens, we could see price corrections of 30 to 50% in some areas. Illinois comes in at number 2, and this state is already in fiscal freefall. Property taxes in Illinois are among the highest in the nation. In some counties, homeowners pay 3 to 4% of their home's value annually just in property taxes. On a $500,000 house, that's $15,000 to $20,000 per year. The economic fundamentals are catastrophic. Major corporations have fled Illinois for business-friendly states. Boeing relocated its headquarters. Caterpillar moved operations. Citadel, the massive hedge fund, packed up and left for Miami. When billionaires are running from your state, that should terrify you. Chicago, the state's economic engine, is in decline. Crime rates are soaring, businesses are closing, and downtown areas are becoming ghost towns. The state government keeps raising taxes to plug budget holes, which drives even more residents away. Illinois has the same pension crisis as California, but without the tech industry or favorable climate to fall back on. The state is trapped in a vicious cycle of declining population, shrinking tax base, and rising taxes. Property values will follow this downward spiral. New York claims the 3rd spot on my disaster list. I've done business in New York for decades, and I've watched this state commit economic suicide. The taxes are outrageous, regulations are suffocating, and the attitude toward business is openly hostile. Thousands of high earners have already fled to no-tax states like Florida and Texas. The real estate market is being artificially supported by foreign buyers and people trapped in rent-controlled apartments. But this isn't sustainable. As remote work becomes permanent, why would anyone choose to pay New York prices and New York taxes? You can live in Miami with no state income tax or Austin with a booming job market. The value proposition for New York real estate is collapsing. The tax base is shrinking as wealthy residents relocate. The state will respond by raising taxes even higher, pushing more people out. Eventually, property prices will crack, especially in suburbs and outer boroughs where Manhattan's prestige can't justify the costs. New Jersey earns 4th place with the highest property taxes in America. You can buy a modest home and pay $30,000 or $40,000 annually just in taxes. That's not a mortgage payment, that's pure tax burden. New Jersey should be thriving due to its proximity to New York and Philadelphia. Instead, it's dying because residents are tired of being taxed to death. They're watching neighbors move to Pennsylvania with much lower property taxes and better business climates. The only thing propping up New Jersey real estate is proximity to New York City for commuters. But with remote work eliminating daily commutes, this advantage is evaporating. Why pay New Jersey prices and taxes if you don't need office access? Business owners I speak with regularly are planning their exits from New Jersey. They're moving south and southwest, taking jobs and economic activity with them. When businesses leave, housing markets collapse. Connecticut rounds out my top 5 disaster states. This state perfectly demonstrates what happens when governments make terrible policy decisions for decades. Connecticut used to attract wealthy New Yorkers seeking tax relief. Now it's driving them away with its own crushing tax burden. Major employers have abandoned Connecticut. General Electric left. Aetna departed. Countless financial firms relocated to Florida. The state's population has been flat or declining for years as young people leave for opportunities elsewhere, and wealthy retirees flee to zero-tax states. Connecticut real estate remains expensive in some areas because inventory is artificially constrained. Current homeowners don't want to sell at losses, so they're holding on. But this can't last forever. Eventually, reality will force a market correction that could be devastating. Now you might be wondering where you should invest instead. The answer lies in states doing the opposite of these 5 disasters. Look for positive migration patterns, business-friendly environments, reasonable tax structures, and growing job markets. States like Texas, Florida, Tennessee, Arizona, and North Carolina are attracting businesses and residents fleeing high-tax states. These markets have demographic trends, economic growth, and migration patterns working in their favor. However, timing matters in real estate. Because everyone knows these states are hot, prices have risen significantly. You need to be careful and do thorough research on specific markets and neighborhoods. The key difference is this: if you buy in a growing state, even if you overpay slightly, demographic trends will bail you out over time. But if you buy in a declining state, even at a discount, you're fighting against powerful headwinds that will drag down values. Let me address interest rates since many people are concerned about higher borrowing costs. While rates matter, location matters more. A high interest rate on property in a growing market beats a low rate on property in a dying market every time. You can refinance when rates drop, but you can't refinance away a bad location. If you currently own property in one of these 5 disaster states, you need a plan. If you're young and mobile without deep roots, seriously consider relocating to growing markets where economic opportunity is expanding. Your biggest asset isn't your house, it's your ability to earn income. If you're older or have family ties making relocation difficult, be realistic about your property's value. Don't assume it will appreciate or provide the retirement equity you're counting on. Plan for the possibility it might be worth less when you're ready to sell. For landlords owning rental properties in these states, watch your numbers carefully. As soon as cash flow turns negative, get out. Don't hold on hoping for a turnaround. In declining markets, hope isn't a strategy. What we're witnessing is a fundamental economic restructuring across America. States embracing free market principles, maintaining reasonable taxes, and welcoming businesses will thrive. States continuing down paths of high taxes, excessive regulations, and business hostility will decline. This transformation will play out over decades, and real estate markets are already reflecting this shift. You have a choice. You can ignore these warning signs and hope everything works out, or you can look at the data and make informed decisions that protect your wealth. The crowd is wrong about real estate in these 5 states. Sometimes you need to go against popular opinion when the fundamentals don't support the narrative. The numbers don't lie, even when everyone else is telling you everything is fine. Here's what I want you to do right now. Take out paper and write down where you're considering buying real estate. Then research 5 critical factors for that market: migration patterns, business climate, tax environment, regulatory framework, and fiscal health. Spend time looking at actual data rather than promotional materials or emotional appeals. Be honest about what the numbers reveal. If the data shows you're about to make a mistake, have the courage to change course. Don't let ego or sunk costs trap you into bad decisions. Don't let other people's expectations control your choices. This is your money, your future, and your family's financial security at stake. The real estate market is unforgiving. It doesn't care about your dreams or preferences. It only responds to fundamental economic forces. Right now, those fundamentals in California, Illinois, New York, New Jersey, and Connecticut are broken. I've given you the warning signs and shown you the data. Now it's up to you to decide what to do with this information. Will you be someone who looks back in 5 years wishing they had listened? Or someone grateful they paid attention and made smart decisions? Remember, in business and life, you don't get what you deserve. You get what you negotiate. If you negotiate with a dying real estate market, you're going to lose. Be smarter, be better, and protect your money. The American economy is transforming, and real estate values will reflect this new reality. Position yourself in growing markets with strong fundamentals, or risk watching your investment become a financial anchor. The choice is yours, but choose wisely. Your future depends on it.